Hello, everyone, and welcome back to our penultimate panel of the day. Today we have some proof of work and mining titans. Ethan will be leading this panel along Leo, Ben, and Timothy, and he will let them introduce themselves shortly. They will be talking about how to decentralize the process of liquidity provision and also how using derivatives within the whole proof of work and mining space. I'm sure they know it much better than me, so without further ado, I will hand over to Ethan, who will be taking this session. I'll be in the audience and just facilitating in behind the scenes. Bye.
Great, thank you. My internet's a bit unstable, so glitch out. One of you will have to take. Thanks everyone for tuning in. Derivatives, and thanks to Vega. On this panel, we've gathered three space, and they're going to be discussing products that they've used and products. While historically miners have in their operations, institutionalized miners these days. So these used. We have a few overall this afternoon, but before a round of introductions, and Ben, maybe let's start with you, and then
Sure. Found out about Bitcoin back in college in 2010. Got into it in 2013. Went full into it in 2015. Quit my job. Went into mainland China. Started setting up Bitcoin mining facilities and Ethereum mining facilities. Did that for several years, mostly selling a bunch of hash rate contracts to high net worth individuals and family offices in Hong Kong who wanted that exposure without the operating risk. And in 2018, we realized that the Chinese space is extremely difficult running a wholly owned foreign enterprise, especially doing Bitcoin mining. So we left, went to North America, and I got picked up by Bitfarms in December of last year. I've been working with them ever since, and I run our mining operations and strategy.
Great, thanks. Tim, you want to go ahead next?
Oh yeah, sure. Well, first of all, Vega, thanks very much for having me. Excited to be here. Quick background on me. I started my career back in '96 trading in Chicago, the Chicago 30-year bond option pit. And then I left and transitioned into brokering back in 2002. So mostly in oil and gas. And then really started following Bitcoin, only Bitcoin really in 2011-12 timetable, because I had a very large client who was very involved in the space, and I was just trying to get up to speed on it. And so, and then I left oil and gas and started Biduta in 2017, about 3 years ago. So our focus is really on nonlinear products, derivatives, structured products, and we do a lot of work in the mining community. So excited to be here.
Great, thanks. And Leo, do you want to end it off?
Hey guys, my name is Leo. My first job after graduating college was also in traditional finance. So I started in Morgan Stanley structuring equity derivatives. And almost as soon as I started full-time, I became fascinated with Bitcoin. And at one point, I just decided I just can't handle traditional finance anymore. So in 2017, I joined a fund here, a crypto fund here in New York, and I specialized in heading the mining strategies and been doing that for the past 3 years. And during this process, I realized there's still tons of education that needs to be done in mining space, and there are a lot of knowledge gaps. And I want to do, my best effort to create frameworks and try to fill those gaps. So I left and started Anisha Research, which is dedicated to hash power and its related financial instruments this May.
Great.
I've been working on that ever since.
Thanks. Let's jump straight into mining discussion. I'll just give out a theme, maybe kick it off to one of you, and then you guys feel free to jump on, build on each other's thoughts, or debate it. The first theme we really want to talk about is, who are the participants of a mining derivatives market? Who are the natural longs? Who are the natural shorts? And how does that differ across products? Maybe I'll start with you, Tim, if you have any thoughts there.
Yeah, no, it's a great place to start. That's how we kind of break down a market, or especially when we're looking and talking to the various participants. In proof of work, I guess we should focus on proof of work. today. Really, we think of course, the natural long as being the miners. And then the shorts are essentially the family offices and funds who are looking to whatever product we're talking about, or we're talking about hash or something along those lines. That would be a family office or fund, maybe looking to buy Bitcoin at a perceived discount. If we're talking about the other side of on-chain Bitcoin options, usually it typically is a market maker that would provide liquidity for, say, a miner who's looking to mitigate price risk. I mean, there could be a host of the long is easy. The natural long is easy to identify in the market, right? But then the natural shorts. It's not a physical commodity. That's where I come from. I come from the physical commodity market, so it's really easy to kind of identify the natural short. Say in the oil markets, it would be an airline. That would be the natural short in a physical commodity market, where Bitcoin's a little unique, as most financial markets are, in my opinion. But maybe I should pause there.
Ben or Leo, do you have anything to add to that?
I mean, not too much to add to that. I mean, Tim really hit the nail on the head. I mean, miners were default long. I mean, if we do absolutely nothing, our position is long. And I'd say if you're a pessimistic bear miner, something is wrong with your choices that you've made. But in terms of people participating in the derivative space, really, I think there comes down to two kinds of miners who are looking to do that. And the first is going to be the kind who are looking to hedge their price risk. And I think the second one is going to be ones who are looking for different forms of financing. And there's not a whole lot of, revenue streams for us or pools of capital for us to tap into as miners. We're seen as highly risky industry by financial institutions. And we're really historically looking at things like collateralized Bitcoin loans. But if you're a good, reputable operator and you've got good equipment, you've got a demonstrable history of operating that equipment regularly with good uptimes, it is actually a fairly low risk trade. You're not really betting on the risk of the operator anymore. You're betting on the price risk and the economic risk. And so I think there's an opportunity there for Bitcoin miners to get short-term capital by pre-selling their hash for these future contracts and tap into pools of capital to expand their infrastructure or, make short-term liabilities that they might need to meet.
That's a really good point. So something like maybe BitUda's structured hash rate forward contract would not only be a hedge for miners, but also a way for financing.
Exactly.
Yeah, either you nailed it. That's exactly what it is. It's really just, for miners, it's a cost of capital, right? Ben, I mean, you're making, here's debt at this price, and this is where I can sell hash, and ultimately, just it's more options for a miner. Just really, what's my cheapest form of capital, cost of capital. So, but
I guess on the theme of like hedge funds or family offices getting involved on the natural short side of mining, what are some ways that you can start getting those funds interested in mining and getting them more involved and educated on it?
I spent a lot of time speaking with family offices. They're part of my primary client base when I started in 2015, building out these mines in China and selling hash rate contracts. That is a bit of a slog, and it's a completely relationship game to deal with the family offices. They're very selective in terms of who they talk with and how they treat you. It's all about the introductions and the networks that you've already had, the relationships, the clients you've already serviced properly. I think that goes way further than actually going through and explaining the math. I do think that there is an opportunity, though, for that math to be very clearly demonstrated. There are very few industries where you can go out and you can get every single day worth of data since the start of the industry, and we can completely model out hash rate profitability over time. We can very clearly see, there's, no 12-month period where these economic conditions happened, or there's no 6-month period where these extreme economic conditions happened. And over the long term, you should be able to forecast that out a lot easier than you can, Bitcoin price. I think the hash rate futures actually are a lot easier to forecast. And especially if you're looking on a USD per terahash basis, as opposed to a difficulty basis, that should be a lot easier to forecast out than the actual Bitcoin price. And so you're going after the family offices, maybe that's not really the area where I think this is the sexiest product. Honestly, I think this should be, highly attractive product for someone who's like a pension fund. These are high yielding short-term instruments. And if you're working with large corporates who are proven reliable operators with low operating costs and good uptimes, what's your risk? The risk is on the price spread. And, on a lot of these contracts, the yield to risk ratio, especially if it's a good operator, is very high.
On that note, Tim or Leo, have you spoken to any like mutual funds or pension funds that would be that style of investor?
Leo, I'll defer to you. We need to. I don't want to monopolize the conversation.
Yeah, definitely not mutual funds or or pension funds, not yet. I think just from my previous experience of pitching mining-related investments to family offices and more traditional funds, I think the most common response is, okay, 100% return looks very, very attractive, but what we really want is a certain 2%, 5% return every year, and that's guaranteed. And in mining, it's while it's much more, it's already a lot more conservative compared to the DeFi investments that or some of the other investments that are that make investors crazy in the past couple of years. But there is still a general lack of certainty, proper risk management methodology when it comes to, okay, how do we perceive risk? How do we quantify some of how these time series fluctuates over time? We have historical data, but they're generally not good indicator for future performances. I think the big hurdle with that is just a general lack of cohesive framework to piece everything together, and not sure how all these components move in unison, and how different components such as price, how that influences hash rate growth, and how that influences fees, which is a new variable that in most recent month that started to become parts of miners calculation. So I want to touch on Tim's point earlier. I think it's very interesting that you mentioned that for oil and gas, it's very so for some of the more physical commodities, it's much easier to find natural the people to take the other side. I think a large reason for that is those commodities you can find consumers. You can find natural consumers for that kind of product. But whereas for digital assets, what are the ways to consume it? The only way that people consume it, but consume by really use it, is still speculative, right? So I think a large part of the narrative of a hash rate derivative is still going to focus on, okay, what is the best way to structure a product that makes it interesting for speculators to be willing to take on that the other side. I think the most popular way to talk about it that we have seen so far is, okay, you can buy a stream of income in a stream of Bitcoin in a discounted way. I think that's definitely one way to craft this story, but I think there's still require a little bit of more work to make it more popular.
Yeah, maybe I could just add to the, Leo's point. Those are great points. It's interesting is I'm very proud of my team. We're actually, when we have done some of these hash contracts, we've been able to introduce new people into the Bitcoin ecosystem. They've never traded Bitcoin before, but are sophisticated traders that understand, and they will, especially when the curve is we'd all know the curve whips around somewhat. The futures curve I'm referring to, the contango or backwardation of the futures curve. When you have a sophisticated trader, you can approach them on a strategy, they're going to respond. And that's been pretty, we've done it. So it's really interesting to see that. And that's why I think this makes it so fun, in such an exciting time. And also, not just to talk about hash, but even on exchange products, on the CME, we're on the CME, we're regulated by the CFTC. So we're not on any of the offshore unregulated exchanges. We're only on the CME. But like, if we know that we have a miner that might want to collect yield or sell calls and just collect price, or do a risk reversal, sell call, buy put, and we have a large hedge fund that wants to, wants to buy at really big size, It's challenging for market makers on still on any. There's not much liquidity. We're not talking about crude oil here. So if we know that, then we might be able to line up some really big size and do it between paper to paper, we call it. And so that's kind of interesting too. If we talk about on exchange derivatives, that would be really interesting. If we know somebody has a bullish bias, when we can approach miners and say, "Hey, listen, guys, we're bid for calls today." Those type of strategies that we would pull from our prior careers, and we're doing that pretty much all. I mean, I'm literally on the CME right now. So you're seeing all these products, I think, coming together, which I think is just great for the ecosystem and the future growth of the ecosystem. As more and more sophisticated players, that's just who we know. We know a lot of traditional folks, private equity, et cetera, who've invested in oil and gas, and it seems to be a lot of excitement around Bitcoin, and that certainly that narrative has changed, and it seems in the last six months as the macro environment seems so much more supportive, of course, of our story, I guess, if you would. So
that's great.
I want to kind of.
Sorry, go for it, Ben.
I think it's interesting to separate out, the two different sides of this contract, right, between the buyers and the sellers of the hash rate, because most of the products that I see out there on the market are, at least in my opinion, they seem highly designed to attract the purchaser of the hash rate contract and not the seller of the hash rate. And maybe that's because, you don't really need to attract miners too much. They've got lots of different, options, available to them in terms of what they do with their hash rate. But the pricing, is very advantageous to purchasers if they understand the math and the historical math. And there needs to be a way, I think, that to separate out the various operating categories, the operating risk category and the economic risk category, and match out the partners and the relative risk profiles with the price. And I think that would make it a lot more competitive in the market and attract a lot more different participants in the market. The hash rate futures as an idea for miners as a form of finance is, I think, really, really attractive, but it doesn't work if, we're assuming that, hey, this is only going to be a 3-month, contract, and we're assuming a 30% discount. For this kind of product to work, we need to be thinking a lot more long-term with our derivative contracts. Most of the contracts are very short-term, 1 month, 3 months, this quarter sort of deal, where, I think most of the risk is on long-term, short-term volatility, right? Over the long term, we're going to experience a lot of periods of really short-term volatile actions that are kind of hard to shield against. But if I can guarantee my revenue for 12 months, then all of a sudden I can actually start operating my business like I'm any other normal commodity producer, right? If you go into the oil and gas space and you're talking about commodity contracts, you're going to be talking on a multi-year time frame that people are locking in their prices. And what that enables them to do is that enables them to go to the banks, and that enables them to finance the equipment, and that enables to finance things like payroll and everything else. On a 3-month time frame, on a 1-month time frame, the risk discount is so high to me as a miner that it's not really interesting to me. It's only interesting to me when the derivative gets much longer, and then I can actually start using that as functioning working capital.
So you mentioned 12 months there. Would that be the ideal contract length, or would you even want to go further out for the entire life cycle?
I'd like to go
2 to 3 years.
I would love to go further out. The further out, the better. My biggest thing that I'm trying to accomplish with mining derivatives is I want to guarantee my payback on my equipment, right? If I can guarantee my ROI on my equipment, then I can start opening all sorts of doors when it comes to actually running my business, as opposed to being worrying about what's the profitability next week, right? Or how am I going to make sure that I can pay, off all my bills if the price Bitcoin goes down $4,000 next month and we just bought all this new equipment, right? Made all these new investments. So the longer, the better for me as a miner. And I understand from the purchaser's perspective, it's, they want short risk and they want a quick payback and they want a quick settlement and they want an in and out sort of trade. But I don't really think of this product as a high volume daily trader. This is more of a long-term purchase, sit and forget about it kind of investment. How I envision it from the buyer side.
Yeah. On the other point, Tim, do you have any comments on, talking to some of these funds if they have appetite for something within the 12 to 36 month range, or is that generally too long for them?
Well, to Ben's point, we absolutely hear that from on the mining side. Usually, it's 24 months. They would love to match up their hash contract with the depreciation cycle of the gear. On the buyer side, where we struggle is they're sure. I mean, there's a price for anything, right? So, but the buyers, they're going to assume price and difficulty risk. They're going to ask for a margin of safety, and that's what we've seen. So we've seen the longest deal we've done, the longest tenor is 120 days. That's the farthest we've gone. But we've priced stuff anywhere from 6 months to 12 months. And it's easier when, Bitcoin is now somewhat stable, but, at 12,000, we had a lot of interest. Of course, miners were looking very actively at deals out for 12 months. But we were very close on a large deal, and of course the bottom falls out on the market, and the deal fell apart. But yeah, no, I mean there's appetite for buy on the buy side for 12 months, but we run into counterparty risk, and we think we have some solutions. We've come up with some. My team has definitely come up, we think, with some unique solutions for the ecosystem, but it's really you're taking on significant counterparty risk. So we've only been able to execute right now. We'd love to grow this globally, but we've been only successful in North America because there is significant counterparty risk. Because the miner, remember, receives the capital within 24 hours. So if they need $10 million worth of hash, they get $10 million, and they buy gear. And then they bootstrap their facility, and hopefully they don't have any procurement issues, and they don't have any to deal with any issues in China, and they can bring on new gear, sell more hash, and bootstrap their facility. So it's a really interesting product if you use it, if you have, which unfortunately I know a lot of people are having issues, of course, it's almost a procurement game right now. But if you're able to sell hash, get gear online, sell more hash, get gear online, it's a lot cheaper than 30%. I think Ben was just saying that arbitrarily, but if you do the math, this is a really attractive trade if you can get the gear.
Exactly.
And that's a big if right now, as we all know, I think.
Yeah, which may be something that Leo can work on with Annika Research, and the build out times for hash rate and forecasting, over the next 3, 6, 12 months, what's going to be the new hardware that's manufactured and how much petahash, does that actually represent? Because that has huge implications for the difficulty futures.
Yeah, absolutely. So before that, I want to touch on several things that Ben mentioned earlier. I think you said something really interesting. The first thing is you mentioned the separation of operating risk versus the financial risk, which is also what Tim mentioned as counterparty risk. I think this is a big roadblock for the process of issuance of hash rate, especially you have various different facilities with a lot of physical variances, and that variance needs to be absorbed by certain entity, whether it's the intermediary that's controlling the issuance process before these hash rate becomes somewhat these contract becomes somewhat standardized and pushed to the buyer's market. So now right now the only thing that does that, obviously one is mining pool. Mining pool absorbs that variance and pay out with expected mining revenue instead of the actual mining revenue. Obviously depends on the payout method of the pool. And secondly, you have these cloud mining platforms that they source hash rate from all these different miners. They absorb the variance themselves and pay out the expected mining revenue to the buyers of the cloud mining contract. I think this is something that will become very interesting when mining becomes more expensive, or the mining equipment becomes more expensive, then barrier to entry becomes higher and higher. And you have all these allegedly $1 million investments into mining facilities, and competition start to converge to a game of only those guys. I think a lot of processes will become more standardized, and the variance will become smaller between facilities, such that the operating risk is much smaller compared to the financial risk. So, and then the marketplaces, or whether it's matchmaking market or a commodity market, can start focusing on, okay, the design of the financial instrument rather than focusing on how to eliminate the operating risk or counterparty risk. So I think that's very interesting. And the second thing I thought that you mentioned, I want to pose a thought experiment, which I've been wondering recently is, okay, so once the block rewards goes to zero and mining becomes a purely fee-based market, and I would assume that hash rate growth will converge to a slower pace, and it will sort of stabilize to a certain range. So when that happens, would it be, one, obviously, is that going to, do you guys think that's the likely outcome? And two, if when that happens, is it much easier to predict mining rewards because the larger variables shift to a fee and a price? Obviously, the uncertainty from prices is impossible to remove. But overall, is it that combination, does it make it easier to make mining investment decisions and make it easier to predict what's your ROI time? Anyways, that's also something I've been thinking about lately.
Yeah. If I could just touch on that thought experiment, in the situation, hundreds, whatever odd years down the road, when Bitcoin block reward goes to zero and there's just transaction fees, I don't think that we're actually going to see a stabilization of the hash rate at all, right? I think we'll continuously see for all of Bitcoin's existence a constant economic incentive to develop better computing power in order, to get profit and gain advantage over other miners. So I don't think we'll ever see a complete flatlining of the hash rate. What I do think will happen is that mining, in my opinion, over the next 20, 50 years is going to be adopted by a number of electrical utilities and distribution companies and primary producers and that sort of clientele as operators. And I think it's going to get entirely predictable. What I think will happen when the transaction fees go to zero, I think it's going to become gambling again. And I think there's going to be a lot of people that are interested in buying hash rate for very short amounts of time and trying to gain advantage just on a gambling basis, like it's roulette. In which case, the mining profitability is going to become even more distorted and volatile.
Yeah, absolutely. I think this is this also related to the duration mismatch between the buyers, the duration preference between the buyers and seller, right? I think in Ethereum, we're starting to see some of the discussion shifting towards that direction on how to capture some of the fee dynamics, because this is a relatively new thing that fees are so high, and it's driven by a sustained hype or whatever, movement, whatever you want to call it. And there are new conversations around, okay, how to extract more value from miners and how to front run them, or just make it a standardized business to pay higher fee to get your transaction prioritized, sort of like high frequency trading infrastructures back in when before that whole the underground cables were built out. So I think there's a lot of very interesting developments in that arena that we can study and borrow from when Bitcoin inevitably shifts towards a higher fee territory.
Yeah.
But I do want to ask. So I think this time preference mismatch between buyer and seller, I think it's inevitable. The question is there a way to introduce, intermediate steps to break? The issuer just does issue a very long-term contract, but when it comes to, but it goes through several steps. I don't know what it's going to look like, but is it possible for it to go through several steps and break down into smaller contracts with short durations, potentially with overlaps when it interact with the buyer?
Yeah, I don't see why that couldn't happen. You could have hash rate holding companies, that are speculating and trying to resell on a short-term basis to investors. I think I can definitely see a market for that emerging, especially as we transition off to Fortune 500 energy companies, who are deploying at small scale, very decentralized, integrated into the infrastructure with a very low cost of production because they're using marginal electricity, right? In which case, then the operating risk also gets decentralized and distributed and reduced because it is a Fortune 500 company that people just due to a number of different factors in their history and their legacy, will just trust them being reliable operators and provider of that good or service, right? So I can definitely see a market for that developing, an intermediary market that's going to say, hey, we're going to take the risk on a more long-term basis and try and make some extra profit, selling on a shorter term basis to different investors as needed, for sure.
That's really interesting. Tim, would love to get your perspective on this too. I know it was announced that some of the Biduda contracts had multiple buyers, so a buyer would take it and then pass it off to another. What was the most amount of times you saw it switch hands in those 120-day periods?
We only did one deal in the secondary, so we only, so that was, these are all really, as I think Ben alluded to, they're typically buy and hold or set and forget, or some people, but others do some more, sophisticated strategies around their length. But the majority, I think, of the buyers are looking to just acquire Bitcoin at a perceived discount. If you bought hash at 12,000, like we had a deal lined up a few weeks ago, and you saw a fall off in price and difficulty rising, that's not too good for the buyers. So, there's various strategies that the buyers employ, but typically it's someone looking to acquire Bitcoin at what they think the buyer thinks is going to be a perceived discount.
Got it. I want to dig into the concept of discount rate that you talked about, Ben, earlier. What do you think would be an acceptable discount to pay for a miner, say 12 and 36 months out? And how does that differ between a contract where you're using it for fundraising, like a hash rate forward, versus a future where it's simply a hedge?
Well, I honestly, I'd have to compare that to my other forms of capital, right? And the area where I'm really focusing on it, I'm not looking to hedge my Bitcoin price. I'm not concerned about that risk. As we talked about, I'm just so inherently and optimistically bullish. I'm not worried about that, and I don't think it's worth the effort and the cost to hedge the price on the downside for what I think is going to be a short-lived event, right? I'm not concerned about a structural correction where Bitcoin goes back to $3,000. I'm worried about a short-term blip, where it dips down to 6,000 or whatever that might be. So if I'm going to look at it in terms of the capital raising perspective, I've got to compare that rate to other pools of capital that I can tap into, right? And so looking at equipment financing, what I would experience, and this is from both oil and gas, and looking at equipment financiers in the space right now, the acceptable range is 12 to 16.5% discount. Now you're going to have to add in 12.5 to 16.5% interest, right? But then we got to add in some discount for time, and we got to add in some discount for risk, and that becomes a lot harder to price. I'm actually not sure what would be an acceptable range, because it's all going to be determined by my other cost of capital and my opportunity to reinvest that into new equipment, which is, as Tim said, is not guaranteed right now. Every day we talk with MicroBT, and there's a different amount of hardware, and it's different models, and it's different delivery dates. And there is no for sure in this business. So I don't know what my fixed price on that is, but I'd be aiming for 16.5% on a year, and I just understand that's probably too low for most investors, because that's what I can get on the equipment financing.
It's some percentage points higher than equipment financing, or I guess the range is shifted up a bit because of that additional risk, but it's somewhere within the ballpark of ASIC financing. It
should be comparable to equipment financing.
Right.
And I can understand there's a spread. I'm not sure how big that spread should be, but it should be comparable to equipment financing if that's what I'm using it for.
Yeah, and Ben, to your point, it's really your decision. I mean, we're agency brokers, so we don't take any proprietary positions. It's totally dependent. We defer to our clients on if they want to hedge. Ben doesn't want to hedge to the downside, certainly. Well, then we would turn to the discussion. Would you look to employ potentially yield enhancement strategies? Would you look to sell calls or call spreads? Would you look to, or we would try to maybe also alert bit farms or if we were engaged, and we are always just trying to communicate to our clients. Right now, we think structurally, we think that the U.S. election is going to cause a catalyst of volatility. So we're encouraging our clients at least to entertain the idea of hedging downside. That we think there is going to be significant volatility. We saw this. We unfortunately did see the out of China. I think most of us saw what happened with COVID in January and February, and we put out a research report that this is going to potentially lead to a real a tail event. We spent a lot of time on that, but I think probably all four of us saw, we had some insight of what was going on in China, I think, than others didn't. But we certainly think that the U.S. election is going to cause, potentially, is going to be a real catalyst for volatility. So we're encouraging all our clients to just consider that. But if they don't want to hedge their downside, that's fantastic. They're a low cost producer. That's great. But we're also saying, I think I'm in a very unique position to advise clients because I traded my own capital for a long time on the floor in Chicago. I blew out twice. Once I was long vol, the other time was short vol. So I've been there, and please learn from my stupidity. It's boy, when you're in a during the some of these macro events that have happened, when I blew out, it is. It's nice to be hedged and positioned properly to take advantage of some of your competitors who might not be. So we just want our clients to be thoughtful about their hedging, and if they tell us, listen, guys, we're not worried about downside. We've got tremendously attractive power prices, et cetera. Then that's great. Then we talk about maybe turn the discussion to different topics. But some people are definitely ascribed, they work with us and we optimize hedges, and they want to hedge at least a percentage of their production. So
yeah, I think most Bitcoin miners do want to hedge a small percentage of their production. And as an operator, we can do that in a number of different ways, because the real risk that I'm worried about on the downside is not being able to make short-term liabilities because of a short-term blip in the Bitcoin price, right? And we can hedge that risk in a lot of different ways. And so that tends to be the approach that I go about it when structuring a Bitcoin business is having things like ample cash reserves to make sure that we don't get stuck in a pinch where we can't meet those short-term cash liabilities. But yeah, there's always a cost and a trade-off to those sort of strategies.
So I'm trying to weave together some of the insights you brought today, Ben. It sounds like a hash rate based contract is the most interesting to you. And maybe is that something that would be on a Bitcoin basis versus a USD because you want that Bitcoin exposure? Or would you rather those contracts be settled in USD?
I think the USD settled contracts will be a lot less volatile, just because that kind of acts as a compensation factor. I think the Bitcoin, if it's physically settled in Bitcoin, especially if it's physically settled in Bitcoin at the end, then that actually adds in kind of an interesting speculative gamble part, where you're not only talking about, okay, what is the value of this cash flow over time, but what's the future value of this cash flow that we're earning now. I think that would be a really interesting contract. For me, I would honestly prefer, as the provider of the hash rate, I'd prefer a USD settled contract because I'm trying to cover my USD based liabilities.
Yeah, to Ben, I mean, Ben's point, exactly right. You would want to match up your assets and your liabilities, and so that's why we use the term plug and pray around here for some folks. It's kind of shocking with some of the mining operations we've spoken to. It's pure, it's literally gambling. But that's kind of foolish. I mean, to match up if your assets and liabilities are matched up in USD, if you're, that would be somewhat foolish. And hope is not a viable business plan in our minds. So, yeah.
Leo, would love to have you weigh in here. Let's say you had all the regulators yours, you had a huge dev team. What would be the best product you could bring to market for miners? What would that look like? And would that be multiple products, or what do you envision like a really good future for miners in terms of derivatives?
Yeah. Okay. So I think the most ideal, and this is completely ignoring the technological path and as well as the feasibility of this. The most ideal is obviously in a public exchange where hash power, units of hash power, is being traded like commodities. And these contracts are the physical variance is being completely absorbed by some form of intermediary, whether it's the pools, mining pools service as custodians, but there are many challenges to that, right? Like one, it's the pricing of that is impossibly hard, and you need just so much more education. You need so much more advance in just even the academic studies of what the hash rate return really is, right? Because right now, when you purchase a unit of hash rate, ignoring the operating risks, you are purchasing a trivariate option. Like you are speculating on price, difficulty, as well as fees, and this is most of these kind of high dimensional options are OTC products. So that's why I think Tim, your approach of starting with OTC first is absolutely the right way to do it. I think just Jeremy Rubin has PoW swap, which hasn't really gained any traction. I think any first attempt at creating a public traded hash rate product is going to face a lot of difficult challenges, not just from regulator. I mean, that's a huge challenge, but it's not even the biggest challenge yet. The biggest challenge is, okay, how do you even explain this to people trying to speculate on this? Most likely, you're going to have something like that similar to FTX's implied hash rate index, where there's no volume, right? It turned out to be a gimmick. I think but to go back to your question, if I were to implement a peer-to-peer based a peer-to-peer hash rate based derivative, I would be considering something like a discrete log contract. I think that is just designed for this kind of forwards. And obviously, there's still a lot of problems with discrete log contracts. I think it needs to be fully integrated with Lightning, but there's a lot of challenges. But I personally really like that path, even though it's far from mature. Yeah.
Great. I think we have a few minutes left, so maybe we'll get like a final take here from people. Tim, would love to hear your opinion too on what PoW is planning for the future in terms of some of these products, and what miners can expect in terms of derivatives they can leverage to better hedge your operations and better finance.
Well, what I just like to say, and I'd love to talk to the Vega team more about this. It's just the OTC. We feel we're regulated. So we're regulated by the CFTC. All the trades we do get reported into a swap data repository. So we started from a regulatory standpoint first. We want to understand I've only run regulated firms. All our chat conversations on a recorded lines and chats, etc. So we went about it that way, become regulated first, and then try to understand and really what we've seen, and I've seen this for 20 years, that the OTC market is very cumbersome, and it's great. I mean, there's a lot of agility you could do. I can do an OTC deal, structure it, send it into ICE Trade Vault, have it done. That's great for agility, but it's cumbersome. So I think what's very exciting is to kind of tie this back into today's discussion about DeFi and all this. And I've got to tell you, I'm just trying to learn as much as I can. I can't learn. This is fascinating. But would I love to see more capital efficiency go in the OTC market when we're doing these contracts? So I see them going on exchange to ICE or the CME anytime soon. No. I don't think the FCMs will pick them up, and to Leo's point, it's going to be very hard, to get those on exchange. But they can happen in a regulated firm like PoW. We could do that, but I think there's tremendous room for improvement with working with in trying to improve the whole concept of OTC bilateral trading, capital efficiencies, onboarding, et cetera. So that's what we're really excited about, making the process a lot less, much more efficient and inclusive. Sorry to. But those are my thoughts.
No, that was great. And then Ben, maybe a final word. You know, what would it take for Bitfarms to start engaging in some of these products? What products you're excited for, and yeah, maybe just wrap up on that note.
Yeah, I think the only thing that we need to engage on these products is to have competitive yields to other forms of capital. You know, and just a quick note, I think maybe one of the things that really needs to be done in this industry, or that's holding this particular sector of the industry back, is maybe just marketing, because I would think that a hash rate future, you know, although it's composed of multiple variables, I actually would think of it as somewhat less risky of an investment than just buying Bitcoin, you know, on a whatever date that you're buying it, whatever price that you're buying it, and holding for that same period, right? So especially if we're talking about the 12 to 24 month contracts, you know, if everything's competitively priced, it's hard to find a time period historically. You look back at all the data from Bitcoin when it started. Is there a 2-year time period where it made more sense to, you know, buy and hold as opposed to invest that same amount of money in mining equipment and get the revenue stream for 2 years and accumulate the Bitcoin that way and get the price appreciation that way? So I think it needs to be, you know, I think we can angle it that way, and you can market the hash rate futures as a less risky form of investing in Bitcoin, you know, as long as you remove that operator risk out of the component. And then in terms of the more retail side of things, it's honestly what a hash rate future is. It's a tradable cloud mining contract. And I think that's how it probably needs to be argued. I mean, Genesis Mining built up a $1 billion business, you know, on cloud mining contracts that are not competitively priced at all if you do the math. And so if you can create there's obviously a demand for cloud mining products. If you can create a place where, or a marketplace where people can buy into the exact same product, but have the ability to, you know, have that product be market price driven, and also have the ability to trade out of that product, I think that becomes really attractive. And I don't see what the difference is structurally between a tradable cloud mining contract and you know, a hash rate future as we describe them.
Just to use our last minute here, what would this type of instrument mean for like a public mining company like Bitfarms? Does that change the like risk profile? Do you think leveraging these things will like increase valuations across the boards for the publicly traded companies?
I think it would simplify our operations a lot and give us access to huge amount of capitals for us to scale up quicker and faster than any other mining companies would. I think you'd actually have a really strong incentive then to become a publicly traded company and to go through all this regulatory and auditory processes that, you know, typical miners don't go through. You know, we're audited by a Big Four company. What Bitcoin mining group can say that? And so when we go into conversations with other large institutions, you know, I mean, we have a couple of different things that we can quickly say. Hey, we went through the Ontario Securities Exchange Commission with a long-form prospectus. We didn't go through, you know, the back door, you know, to get listed on the exchange. We checked every single one of their boxes. You know, hey, we're audited by Ernst & Young. Now we're audited by PwC. Like, you know, these are major boxes that you need to tick. And my experience is when it comes to getting people comfortable, people are most comfortable when they see other people are comfortable with it, right? They don't actually want to do the due diligence and the audit work themselves. They want to see that someone else did it, and okay, I trust them to do that work. So I think if these products did exist, it would be a huge boon, especially to the publicly traded companies, and give us huge ability to scale up and run our operations properly.
Great. That was a good way to end it. Let's get these products built. Let's push forward North American mining. And thank you, Vega, for having this panel. Tim, Ben, Leo, this was great. Really enjoyed chatting with you guys. Thank you, everyone.
Thanks, guys.
Yeah, thanks, guys.
Thank
Great
you.
to be here.
It was amazing. It was really nice to hear about the production side of things. I haven't talked about mining in such depth since 2017, so this was brilliant. Okay, we'll take a 5-minute break after this and go on to our final panel. Thank you all for sticking with us for so long, and I really hope you enjoy the final thing we have for you today before we wrap up. All of this is recorded, it's being live streamed to our YouTube channel as well, so you're going to get a copy of this at the end, and you'll also receive a big report on everything we've done today. Thank you, and see you in 5 minutes. Bye.
Cool.